Hey guys, welcome back to my channel. In this video, we are going to discuss about liquidity ratios and more importantly about current ratio and quick ratio. So starting with what exactly are liquidity ratios, you can say these are financial metrics that we use to determine how efficient or capable is a company in paying off its debt. So it measures a company's ability to pay its debt obligations without raising any external capital. What I mean by that is, if a company is borrowing a certain amount of money as loans, it has to later pay it off, right? Now, whether the company is comfortably able to set off its loans in the future using its current assets is measured using liquidity ratios. Now, the first one that we are going to discuss is current ratio. Now, what exactly is current ratio? Current ratio measures a company's ability to pay its current liabilities with its total current assets. Now here we need to understand first what exactly are current assets and what exactly are current liabilities. So current assets are assets that can be converted into cash within 1 year. Okay, so when we are discussing liquidity ratios, we are talking about setting off loans. So here we consider those assets that we can convert into cash so that we can use that capital to pay off our debt, right? So assets that can be converted into cash within 1 year are considered under current assets. Now some examples of this are cash and cash equivalents or accounts receivable. Accounts receivable is the amount which is due to be paid to you. Say for example, if you have sold an inventory to a party and you have not received the cash yet, so there is a certain amount that you will be receiving from that party that comes under accounts receivable. And inventory is your product stock or goods lying in your warehouse that you're going to sell and which will eventually be converted into cash. So all these assets come under current assets. Now let's understand current liabilities. So current liabilities are basically short-term obligations, or you can say loans or debt that need to be paid off within 1 year. So these are the loans that need to be set off within 1 year itself. And examples, you can consider short-term debt, any debt that needs to be set off within the same year, and accounts payable, any payment which is due, which needs to be paid soon. So these liabilities come under current liabilities. Now the formula for current ratio is current assets upon current liabilities. The whole point of current ratio is to analyze whether you can set off your current liabilities using your current assets. So whether your current assets are capable enough to set off your current liabilities. That is what we are trying to measure here, right? So this example will make it clear. So this is an example financial statement, say for example of a company. So here you can see it consists of particulars including cash equivalent, inventory, prepaid expenses and everything. And the total current assets come out to be $1,75,000 and the current liabilities are $1,70,000. So if you calculate the current ratio using the formula, then you'll divide 1,70,000 with 1,75,000 and you will get the current ratio as 1.03. Now what this indicates is that your current assets are larger than your current liabilities. So the company is comfortable enough to pay off its loans using its current assets. So current ratio greater than 1 is considered good. Why? Because the company's current assets can be used to pay off the short-term obligations that a company has, right? Moving on to the next ratio, we have quick ratio. Now quick ratio is similar to current ratio. However, it offers a more conservative view of a company's liquidity. What I mean by that is, here we don't consider the inventory. In quick ratio, we do not include inventory or any assets that cannot be converted to cash so easily. So quick ratio focuses on companies' more liquid assets. More liquid assets mean assets which can be converted to cash easily so that you can use that amount to pay off the loans. And the formula for quick ratio is current assets minus inventory upon current liabilities. Okay, or you can also write it as cash plus cash equivalents plus marketable securities plus receivables upon current liabilities. Now both mean the same. Why? Because if all these four components are a part of current assets itself, and current assets also include inventory, so either you subtract the inventory from current assets or write the individual components, it means one and the same. So quick ratio considers all the current assets except inventory, and you divide it by the current liabilities, you will get the quick ratio. Okay, this is a more conservative measure of the company's ability to pay off its current liabilities. Okay, and the example of quick ratio, as you can see, so in this case the marketable securities turn out to be $3,50,000, account receivables is $6,50,000, and cash is 50,000. So the total current assets that we are considering for quick ratio are $10,50,000 and the current liabilities are $8 lakh. So the quick ratio, if you divide 10 lakh 50,000 with $800,000, you will get 1.31, which is the quick ratio for the company. So the difference between current and quick ratio is that in quick ratio we do not consider the less liquid assets like inventory, and that gives us a more conservative approach. So what are the key takeaways out of this video? So quick and current ratio both are liquidity ratios that help us to measure the company's ability to meet its short-term obligations, which we call current liabilities, loans that need to be paid off within 1 year. And the current ratio divides current assets by current liabilities, and the quick ratio only considers highly liquid assets as a part of its current assets. So that's it from this video. Hope this video was helpful. Thank you so much for watching. For more finance and investment related videos, you can subscribe to this channel. Make sure you like this video and share it with your friends. Thank you so much for watching. Bye.